Hello investors, welcome to monthly interaction with Canara Robeco Equities team. The last month has been eventful in a way that what we were putting up as a base case that the ceasefire will happen and the conflict will recede in few months has played out to a great degree. Of course, there is no 100% certainty on the event to be over, but at least the initial signs are clearly there. There is a temporary pause. There is a pause to conflict. The oil prices have come down, and that's more critical for us. So the cascading impact of higher energy prices, both on macro and micro, on India would be contained, assuming that the oil prices stay in a band of $70 to $80. Our base case still remains the same, that we don't see this conflict actually persisting. I don't think there is any incentive for US to continue it with it, and there is very limited incentive for Iran also. In fact, Iran has ended up being beneficiary of this war because now their part of their frozen assets are being given back. Their oil, which was under the sanctions, has been lifted partly, at least, if not fully, and so their economic activity at the margin will be better than pre-war. So they have come out effectively victorious out of this event. So that's one that what we're estimating, just like what has happened in last 20 years, there are events which happen, market reacts to it, but more often than not, most of these events pass in 3-6 months a year. Then it looks like okay, this was bound to happen. I think this is one more case of that. That's one. Second, of course, the India-US tariff deal, it seems to be in the final legs. So if you have to sum up the global worries that were there for last 4 to 6 quarters, initially the tariff related aspects and the higher tariffs on India versus the rest of the world by US, and second, this geopolitical tension which resulted into higher energy prices. Both these aspects seem to be gradually fading, and that's a good news for India on macro side. It clearly means that whether it is your current account deficit, whether it is your inflation, whether it is a possibility of interest rate increases, they have all these basically negative possibilities have gone down with this conflict receding. So that's the global piece. On the local side, clearly the incremental worry because of El Nino on the monsoon side is still there. It's too early to call out, but two basically pointers on this. One, a 10% deficit in rainfall doesn't necessarily mean a bad outcome, because it is more to do with the way distribution happens. There are 36 divisions in India in terms of rainfall. If the distribution of rain is relatively even, then the outcome should not be so bad, and there have been years where this has happened in the past. That's one. Second, also there is no basically perfect correlation of economy or markets doing really bad versus the bad monsoon in a particular year, given that a below average monsoon also mean that government will be more supportive to the rural part of the economy, and that has been the precedent. So these are the two aspects, and that's where while June has been bad, July has started well across most of the divisions. We'll have to wait till probably July end or mid of August to make a final call on monsoon. As of now, our base call is that since the June was significantly deficient, July, August, September relatively should be better. If that is the case, it will not be so much of issue 1.5 to 2 months down the line. So that's on the domestic side. I think rest of the domestic parameters continue to be healthy despite the conflict and issues around it. The credit growth has actually flared up to 17.5% almost, which most of the people seem to be ignoring. That even if I adjust it for the working capital requirement, you are trending a 15% credit growth, which is a very, very healthy sign. The liquidity, RBI has been keeping liquidity in surplus persistently. The inflation has not surprised negatively even with the latest numbers. So most of the auto sales continue to be healthy. So most of the macro sectoral parameters continue to be healthy. The third piece in generally our discussion is around earnings. As we have been saying that after almost 5 to 6 bad quarters in the market, the earnings had started recovering in the second half of financial year 26. The third quarter earnings recovered to high single digit, and in the fourth quarter the earnings were already in double digit. To be precise, Nifty 500 reported 13% earnings growth. Mid cap, small cap reported upwards of 15%. The large caps reported around 10-11%. So all in all, the earnings drought that was there for the previous 5-6 quarters, that is starting financial year 25 and then first half of financial year 26, seems to be behind. Credit growth, surplus domestic liquidity. Now the FCNR deposits, which by various estimates are likely to be anywhere between $30 to $50 billion, will mean that with the war ceasing for the time being and oil being at $70, clearly all these indicate that the earnings trajectory recovery is likely to continue. Having said that, of course, in near term, because there will be inventory of higher energy prices and commodity prices of previous quarter, the first quarter in terms of earnings, particularly the margins, is likely to be subdued across the segments where commodity is the raw material, whether it is apparel manufacturers whether it is cement, whether it is the industrials, everywhere wherever there is either energy or commodity usage, they will have a margin impact for the first quarter, and that's a well understood phenomenon. So there is no surprise if the first quarter numbers are little weaker on the margin side. But if the top line continues to be healthy, I think that will clearly indicate that the market is likely to see through these events in terms of how the earnings are likely to play out. So as of now, we are continuing with our base case that financial year 27 and 28 consensus earnings growth of roughly 14-15% is more on track than not. You should expect earnings recovery to continue through this year. The market valuations are far more benign than where they were. You have gone through almost 2 years of consolidation now. While there are a lot of ups and downs, still we are in the same range. Large caps are probably down 10-15% from the peak. Small caps are down actually even more from the peak. Mid cap as an index relatively has done well because the earnings in that part of the market has been good. But all in all, the valuations for large cap at roughly 17.5 times financial year 28 consensus numbers. Mid cap, small caps at anywhere between 22 to 24 times consensus numbers. All of them are far more benign. Large cap is absolutely cheap. Small cap earnings estimates are far more benignly built today. So again, very, very attractive. Mid cap is the only category where valuation and earnings exuberance is still there. So from our preference perspective, large cap, small cap, and then mid cap, that is the preference basis the valuation where the valuations are. Clearly, this year, as I said earlier also, we expect a recovery in the earnings, and that recovery in the earnings at a valuation which is comforting today should lead to market going out of this consolidation zone where it was for last 2 years. Of course, this will also be aided by, if it plays out, the AI trade largely seems to be towards the end. There seems to be a fatigue that is building in some of the global AI trades, so that will be positive from flows perspective because the FIs have sold $30 billion in just first 6 months. Last whole calendar year they just sold $20 billion. So there has been a continuous selling from FIs, given that a lot of these AI commodity markets globally were doing better than India. That trade gradually getting into that exuberant zone and fading should actually aid India. This conflict actually receding should help India on the macro side, given the oil prices range which incrementally we are expecting, which should pass through the margin expansion for most of the companies in coming quarters. So global tariff policy is likely to be in place. So most of the big global worries seems to be at least past their peak and receding. The domestic worry still remains in terms of how monsoon is likely to play out. But as I said, distribution is more important than just the deficit. So we'll look out for that data point. So all in all, more likely to get out of consolidation zone. We are relatively more constructive given that the consensus earnings of roughly 13 to 15% or 14-15% is likely to play out over next 2 years, and the valuations are far more benign. So that's where the market view is right now. In terms of our portfolio positioning, we are overweight financials, both large financials as well as the select NBFCs. We see financials at 15% credit growth to be a place in market which is more likely to surprise in the earnings in coming quarters. Pharma, we continue to be overweight on through hospitals, domestic branded names, and one or two of US generic names. Telecom, consumer discretionary is a large overweight where we are playing the quick commerce, where we are playing the jewelry retailers, where we are playing the select autos. So consumer discretionary, pharma, financials, telecom, hotels, these continue to be overweight in the portfolio. The underweights in the portfolio still continues to be IT and FMCG and metals predominantly. These are the three underweights in the portfolio. Industrials, which has been a very interesting part of the market over last 1 year. Gradually we are turning less and less constructive on that part, more driven by the excesses in terms of valuations that are happening there, whereby the companies are trading at peak multiple, at peak earnings estimates, peak margins, and huge ownership, whereby even FIs have come and joined the party in the industrials. So that's how sectoral positioning is. So industrials, eco-weight, underweight, financials, consumer discretionary, pharma, telecom, hotels overweight, and commodities, oil and gas, metals, and IT being the predominant underweights in the portfolios, while the positioning will be different in each of the portfolio to some degree at aggregate basis. This is the house positioning for us as of now. This is largely from our side for the month that has gone by. Thank you. See you the next month.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.